Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Alrighty, welcome to the Smart Investing Show. I'm your host, Chase Wilsey, for today, and with me is our certified financial planner, Harrison Johnson. Harrison, thanks for joining me today. Got a lot to talk about. Going to start off here pretty hot. Will the stock market crash? We're going to dive into that. Also, too, we're going to talk about what's going on with consumer credit. Also, then we'll talk about the real estate market. I know Harrison's got some interesting information on mortgages, and then I'll kind of look as well at the investor base buying up homes. So full show there in terms of topics, and then companies we'll cover includes Carrier Global, Polaris, and then Align Technology. With that, let's jump into it. And as I said, will the stock market crash? I have a ton of information here. I should say we have a ton of information here that I'm going to say is a little frightening. So let's get into the numbers. We're going to talk about this. Kind of discussed this before, but the top 10 companies right now account for nearly 40% of the entire index. We've never seen anything like that. Even during the tech bust, I think it was around like 20-ish%. And then we've talked as well about the forward PE being around 22 times for the S&P 500, well above the 30-year average of about 17 times. So, looking at the forward earnings, the S&P is very expensive.
It's very expensive. And to your question of will the stock market crash, the answer to that question is always yes. That's what it does. It goes up and it goes down. But the point we're talking about here is all these metrics that we'll get into on the valuation and why things are expensive. The S&P is, you talk about the market, the S&P, 500 companies, but it's really a very large portion of it is comprised of 10 companies, and all those 10 companies are extremely expensive, not from the stock price, but just in terms of how much earnings you get for those stock prices. But also the rest of the market too is fairly expensive as well.
Yeah, things are just very expensive, and I've kind of talked about this before, but if we were to go from, again, that 22 times multiple down to 17 times, that'd be a correction on the market of about 23%. And the issue is, you can kind of counteract that with obviously earnings growth. So let's even say earnings on the S&P grow by 5-7%. That then means to get what I'll call a fair value around 17 times. You'd still have a decline somewhere around 15, 16, 17%. So that's kind of where we're looking at. The earnings, you're paying too much for them at the end of the day. If you look back to the tech boom, I think it peaked out around 25 times the future earnings. And at this rate, I don't want to be here sitting, it could go to 25, 26 times. To me, the risk to reward of buying the S&P 500 at 22 times, hoping it goes to 25 times, not worth it.
And it definitely could do that. The valuations themselves are not what causes things to unwind and things to go down. You can't predict it. This is why nobody can time the market, because it's something unpredictable that comes along and causes the downcline, and then how out of whack the valuation is determines how drastic that decline could be. And again, we don't know when that is or what that looks like. It very well could go to 25 times future earnings, could go higher than that, who knows? And that could take a year or two or three, or however long it takes. But coming to the numbers, this is as expensive as really it's ever been.
Yeah, and we talk a lot about the future earnings, but there's other indicators too that are very troubling. And one that maybe is lesser known or not talked about as much, it's called the Buffett Indicator, and that looks at the total U.S. stock market value compared to the US GDP. And I thought this is kind of an interesting way to value stocks. And Buffett, and obviously referring to Warren Buffett, who is arguably, I would say, most would agree with this, is the greatest investor of all time.
Well, he's got the track record. He's 100 years old.
He does. But he even made the claim at one point that this was the best single measure of where valuations stand at any given moment. The problem, it now exceeds 200%, which is a historic high and well above even the tech boom when it peaked around 150%. This is just crazy when you look at the valuation based off this Buffett indicator. Again, just another measure showing you how expensive the stock market is.
It's supposed to be around 100%. Right?
Somewhere around there,
I think that's what he said is a good value is the total market cap of all the U.S. companies should be about what the GDP is of the U.S. economy. So those should be in line. And at the tech boom, it was 150%. So that was a high valuation. Right now, 200%. So a different way of looking at it, and as you said, different than what you're paying for the earnings. This is just the stock market, which at the end of the day, people putting money into the stock market, people buying things causes the market caps to increase. And so now the value of all those market caps together are, again, twice the size of the GDP of the U.S.
And I mean, it kind of makes sense because you're going to need, again, domestic production or the value of the economic kind of capacity to be somewhere in line with the value of the U.S. businesses. Because if the GDP and the growth of the economy is not there, it's not going to be able to justify further growth in the stock market.
Long term. Yeah.
Long term.
Short term, anything can happen. Long term, which is every decision should be made from a long term perspective.
Yeah. So, I mean, that is, again, another valuation that is concerning. And a third one, too, that I was looking at that, again, maybe lesser known, lesser talked about, it's called the Shiller PE ratio. And what that looks at is the average inflation adjusted earnings from the previous 10 years in relation to the current price of the index. And it's essentially trying to remove the cyclicality that comes about in, business and the economy over, again, those 10-year periods. But the multiple now stands around 39 times, which is also well above the 30-year average, 28.3. And at that level, we've only seen it really, again, during the tech boom. I mean, the fact that we're talking about all of these valuations historically just don't occur outside of one of the worst declines that we have ever seen, which was the tech bust. So, I mean, to bet on an increasing market at this value, it's troubling to me because, as we say, it can go higher. I personally think it will. I mean, you talk to people right now, and they're like, oh, well, yeah, I didn't do very well on this one, but I think I'm going to sell that and go buy NVIDIA. Or, oh, I think I'm going to sell that and go buy Microsoft. And I still think, it's kind of scary to say, but I still think there's more room in this bubble before it pops. And unfortunately, as there is continued growth in that bubble, I worry that downside just gets worse and worse.
And that's exactly what happens. And it's not only that, but it's also, people who are, have been very afraid of the stock market for a very long time, their whole lives, their whole adult life, their whole working life, whatever. People who are traditionally very afraid of investing in anything in the stock market are, well, I've heard about NVIDIA. I'm going to buy NVIDIA. I'm going to buy Apple. I'm going to buy Microsoft. And so you have money out there flowing into these things from people who, don't really understand what they're doing. They just see that something has done well. And as long as people continue to do that, as long as people continue to buy an asset, whatever it is, it will cause the price to go up no matter what the underlying, fundamental reason is.
And I think just because of that reason, that's why I think there is more room for this continued growth is because we're still seeing people have these conversations, and you're not really seeing the ultimate level of skepticism where people are like, I don't know, NVIDIA is now worth over 4 trillion. Can it go to 8 trillion? People aren't talking about that to the same level of degree that they're talking about, yeah, but it's up 1,000% over the last X number of years, so I'm going to buy it. And, again, you use that example of people that hated the stock market buying NVIDIA. You talk to people and they have maybe a stock market index and they're like, yeah, but I also have NVIDIA. I mean, that is something that is troubling because that is, I think, fueling, again, the overvaluations in a lot of these stocks and, again, the S&P as a whole.
Yeah, which valuation doesn't matter until it does.
Yeah, and that's the hard part. And, we talk a lot about valuation, and it's funny, people don't care about valuation anymore. I mean, I care about valuation. I think you should care about valuation because ultimately that is the driver long term. But there's also some other factors in the stock market that are troubling. And a big one, and this one, when I saw this, I was taken aback by it, margin expansion. That can be disastrous. I mean, margin essentially allows investors to buy stocks with debt. But the big problem is if there is a decline and a margin call comes, well, the investor would either have to add more cash or make sells. Most of the time, if people are margining, they probably don't have the availability to add cash, so they would have to sell that position. That would then cause a further decline in the stock due to added selling pressure. So it can create this cascade effect where, selling starts, margin calls come, and then selling even accelerates to a further degree.
Yeah, and in this case, we're not talking about profit margin expansion. We're talking about margin in terms of debt, essentially leverage. And I think another part of that, too, is since there's been appreciation in the market, people don't want to sell things and realize the gains on those, so they'd rather borrow. And so what that can compound is if things do turn around, not only do you have margin calls where people, again, don't have the cash to put in because they're borrowing in the first place. If they wanted to invest, they would just invest the cash that they have, not borrow additional money to do it. But what that means is, that can cause things to come down. But if they're also then forced to then sell things that still have gains, now they also are going to owe taxes on that. So they have to sell to pay down the debt because the prices are falling, and they have to sell to potentially pay the tax bill on the assets that they have.
Yeah, I mean, so margin can be disastrous. And when you look at the underlying influence of it, debt generally is what can cause crises.
The biggest ones that we've ever experienced have been caused by debt.
Yeah. It can just derail an investment plan. It can derail a consumer. And I mean, when we look at the numbers here, margin debt has actually now topped $1 trillion, which is a record. And it has grown very quickly, considering there was an 18% increase in margin usage from just April to June. This was one of the fastest 2-month increases on record. And this is what, again, scares me. Rivals the 24.6% increase in December 1999 and the 20.3% increase in May 2007.
What's interesting about those dates?
Gosh, the next year was just absolutely terrible if you were an investor. And, this is just, again, another thing to add to, your arsenal, so to speak, about why things just aren't making sense right now. And I mean, you talk about margin as a share of GDP. Again, looking at these relationships, it is now higher than during the dot-com bubble and near the all-time high that was reached in 2021. Even looking at 2021, what happened in 2022? Stock market fell 19%, I think, for the full year.
And interest rates were nothing at that point, so it was easy to borrow.
Yeah, exactly. And we also talk about another concern with margin is that doesn't even include what we call S blocks or equity-backed lines of credit. If you're borrowing against your portfolio, we call them generally S blocks. That is not part of margin, but that is another tool that people are using to maybe forego those capital gains and taking on debt instead. But the problem is they are still subject to the margin call, essentially, and I don't know if it's called a margin call.
It's called a maintenance call.
Maintenance call.
Same thing.
Where your portfolio goes down, let's say 20%, you leverage that portfolio. Now all of a sudden the bank calls and say, hey, actually you're going to have to sell some stuff because we want our money back. Your assets no longer qualify you for essentially borrowing that amount of money. You then have to make sales. That then, again, adds further pressure.
I've also seen, because, Schwab offers these, Goldman Sachs offers, a lot of custodians offer those types of things. And again, a margin loan is you borrow against positions that you have to buy more stock. A securities-based line of credit is you borrow against your shares, but you don't use it to buy more stock. You're using it to buy something else, a car or a house or whatever. But the underlying collateral is the stock. So if the stock goes down, you still are forced to sell in the same way. And one thing I've noticed is a lot of these custodians are decreasing how much credit they're willing to extend. You used to be able to borrow like 65-70% of your portfolio. Now you can only borrow up to like 50%. But what that means is if somebody had a portfolio and at the time they borrowed maybe 45% of it, oh, well, I'm still very far away from my margin or my maintenance call because I can borrow up to 75. Well, as those restrictions have gotten tighter, now they're very close to that if they can only borrow up to 50%, which could cause selling if there is some volatility.
And I don't know the exact history of these S blocks. I know margin's been around for obviously decades, but I mean, when you look at these S blocks, again, they're harder to kind of find. They're buried in the consumer kind of borrowing numbers. So the most recent number I could find was actually from Q1 2024, and it was estimated that the S blocks totaled about $138 billion. So again, even using that number, you add to $1 trillion, you're about $1.2 trillion. I would even assume we're higher because of this risk on because of the increased tax burden. I wouldn't be surprised if the S blocks were now pushing $200 billion, if not higher. Mm-hmm. But I don't know if S blocks were around back, in the tech boom and bust. I don't know if they were around during other financial calamities.
I don't think
it could cause further problems.
I don't think to the extent that they are. I mean, it seems like they're becoming more available for normal investors. Super wealthy people have used these things because they've never wanted to sell assets and pay taxes, so they would use credit lines to do things, whether it's a S block or any other type of loan that they would set up against their assets. But now it's becoming easier for retail investors to open this up. So this is a new line of credit that's becoming more prevalent.
Yeah, and I mean, this all kind of comes with the fact that we've been in this market where essentially you always buy the dip and it always comes back. I mean, really, it's been that way for about 18 years. So it's created this whole investor base of people that have, number one, maybe never gone through an extended downturn, or number two, people that have short-term memories and forgot about the extended downturns.
Or they've gone through it, but not at the extent that they have. So
if you were 30, you didn't have much money back in the tech
So
boom.
yes, if you had, $20,000 and you lost half of it, it was $10,000, big deal. You might have heard at the time, but now if you have $3 million, losing $1.5 million on that hurts a whole lot more. So it's been close to 2 decades since we really have gone through something difficult.
Yeah, because I mean, you look at 2020, 2022. I think 2018 was another difficult year. I mean, everything pretty much bounced back the next year. So I mean, that's why I always tell people, you go back over history. You got to understand that this is not normal to see these types of intense bounce backs.
It's not usually this easy.
Yeah, it's not usually this easy. That's a great way to put it. I mean, if you look at the tech boom and bust, and this again, put in perspective how troubling it was when valuations just got out of control. The S&P 500 fell 49% in the fallout from the dot-com bubble, and it took you about 7 years to recover. I mean, if you want to include the financial crisis in that, it took even longer because obviously you recovered about 2007, and then it crashed again in 2008. So, I mean, very difficult time period. The NASDAQ, on the other hand, which is way more growth heavy, the valuations were even probably way more out of control. That fared way worse. It dropped 79% during the tech bust, and it took you 15 years to get back to those record levels.
Yeah, I mean, you talk about taking an 80% loss. There's a lot of people in retirement that cannot handle that.
No, I don't know how you withdraw income while you're losing 80%.
I mean, you can't. You run out of money. You lose 80% as you're withdrawing money. You run out of money, especially since it took 15 years to come back. You're done.
Yeah. So, I mean, that is just why, again, valuation matters to us. And even, we talk about the tech boom and it's like, oh, it's different this time. I mean, there's other periods of history that we've seen similar situations. And I actually just recently learned about this one. But if you look back at the start of 1964, the Dow was at 874. By the end of 1981, it was 875. So again, over a 17-year period, you gained 1 point in the Dow. Now, this was an extremely difficult period that obviously saw the Vietnam War spending, stagflation, oil shocks, but it again illustrates that difficult markets with little to no advancement can occur.
Yeah.
And that is just something you have to keep in the back of your mind. Are we going to see a period of time over the next 15 years where we've appreciated something crazy like 12 to 15% on the S&P 500 over that time period? Again, I think it's much more likely you're going to see appreciation over the next 15 years of 0 than appreciation of 15% per year.
Right. I mean, it's possible. Who knows? Maybe these tech companies are all investing in AI, so maybe AI is going to be the greatest thing that's ever happened to humanity, and things just continue to increase forever. It's possible.
Do I want to make that bet?
It's also possible that things that have happened before, like we talk about the tech boom and bust all the time. We're beating that horse to death. But like you said, 1964 to 1981. So that stretch, no gain at all in the Dow. So it's not only the tech boom and bust. There's other periods in history, and it doesn't happen every year. But when it does happen, it lasts a very, very long time. And it's been a long time since something like that has happened. And we're not saying that that's going to happen next week, next month. Things could continue. Things could continue to go indefinitely. But generally, that doesn't happen.
Yeah, and I mean, I don't want to scare you completely out of stocks. I don't think that's the goal here. I mean, You should still be investing your money. So, I mean, what are we doing? We're sticking to the value approach. Obviously, you listen to the show, we're value investors. Hasn't been the most successful strategy if you were buying NVIDIA or something else over the last 10 years. Congratulations. But we stick to the value approach because during those difficult periods, value generally holds up much better. We look at the Russell 1000 Value Index as an example. It was actually up 7% in the year 2000 when the growth index fell about 22.4% that year. Even during the tech bust from 2000 to 2003, I think it was down around 15%, again, compared to a decline of 79% for those growth stocks in the NASDAQ. So that value approach can do well even when growth fails, or worst case, it holds up much better than the difficulties you can see in growth investing. Also, too, personally, we're holding the most cash we've held in the portfolio since about 2007. We're getting paid around 4% in money market. Take advantage of that. I think it is wise to maybe keep some cash, continue to look for good investments, and if you find them, it's not a bad idea to deploy some. but be very careful. I don't think you should be fully invested in this growth craze because, gosh, I think you could burn yourself 5-10 years down the road.
Yeah, no, I mean, and again, we will see how it goes. Things can continue until they can't anymore. I mean, nothing lasts forever.
Yeah, just one last topic on that. We spent a lot of time on it, but there's one other person that has a lot of cash right now. Warren Buffett, again, mentioned him quite a bit. Berkshire now has a record cash hoard near a record cash hoard, technically dipped a little bit, of $344.1 billion, and the conglomerate has been a net seller of stocks for the 11th quarter in a row. I don't know if that's telling of something. I believe it is, but I'd rather follow somebody like Buffett in this case than people
Buffett.
Chasing the meme stocks, chasing cryptocurrencies.
He's an idiot. He should just buy NVIDIA. Like
he's old
else.
school. Yeah, exactly.
He doesn't know anything.
So again, I mean, I want to be clear. Obviously, there's a lot of concerning data points out there. I think it really applies more to the broad-based market, to a lot of the growth sectors. I think there is still opportunity within the value segment. But if you're in those companies, congratulations, you've done well. I don't think it's going to continue. And I could be wrong.
Go take a look at our newsletter, because this article, I think, has a lot of good information, because value investing is all about, price to earnings, what you're buying. But there's all these other indicators, and that article in the newsletter goes through all of these, and it illustrates some things. So, I think a lot of people would find that useful.
Yeah, and that is, again, just on the website, smartinvesting2000.com, if you actually want to read through the details of it. But with that, let's kind of jump to the next subject here. We're talking about consumers are doing a better job managing their credit card debt, and I'll tell you, this is one reason I don't think that bubble is going to burst quite yet. I don't think the crash is coming today, tomorrow, next week. I think we're maybe a year, 2 years down the line is where things could start to percolate and have issues, because the consumer is still doing well, and debt balances for consumers are actually still doing okay. But data released by Truist Bank analysts showed that cardholders of both higher and lower scores are doing a better job paying their bills on time. That's based on a drop in the rate of late payments from last quarter. So good to see we're not seeing like a huge flow into delinquencies at this point.
I'm kind of surprised.
I was surprised by that. Yeah. And also a big one too that we look at is the debt servicing payments were roughly about 11% of disposable income. And that means nothing at all unless you compare it against something. But that's below what was typical before the start of 2020, and it's far below the 15% plus levels that were seen leading up to the Great Recession in 2008. Big problem in 2008, 2009. Talked about how debt can take down economies, can take down investors. That is a big reason we had huge issues in the financial crisis, was people had too much debt. Right now, we're not near that level.
And the other thing, I mean, it's encouraging to see that, because even though interest rates right now are higher, still the amount of someone's discretionary income that's going towards debt service, again, with that higher expensive interest rate, is lower than other levels that we've seen. So that is a promising sign.
Yeah, I mean, we're not seeing crazy debt growth, which is nice, especially if you look at credit card growth. That's where I think you can see a lot of concern, because if people really start loading up on credit cards, you can tell they are financially constrained, because credit card loan growth was only 3% year over year. So we're not seeing a huge growth there, especially, I mean, that's right about in line with the level of inflation. Mm-hmm. I think that's okay. That's healthy growth if you look at credit card debt growth. And what could be happening is lenders are increasing their lending standards, and those stricter standards also make it more difficult for subprime borrowers to obtain new credit cards. And that comes with the fact that as a share of new card accounts, the category accounted for just 16% of all new accounts. That was down roughly 7% from the last quarter in 2022, when it was 23%. And this is important to me because banks hurt themselves in the financial crisis. They were doing bad loans. They were taking on bad clients. Banks right now, I still believe, are very strong. They have a good client base. They haven't really over-leveraged themselves. They haven't written the type of bad loans that they did pre-2008.
Yeah, so that's totally different. Banks are underwriting better. They are, following guidelines a little bit better, but that doesn't mean that individuals aren't hurting themselves. Because if you're, using an asset as collateral to do something dumb, well, the bank doesn't care if they've got the collateral. In this case, it's credit cards, which, if that subprime borrower level, if they're not extending as much credit to those, I think that makes sense. But overall, card growth of only 3%, I think is pretty good.
Yeah, and I mean, the thing that I look at here as well is consumers might be more aware potentially of higher interest costs, and this one always kind of cracks me up, but credit card interest rates stood at about 22% as of May, and there's been a decrease since the peak from last year. but it has increased from 2022 when interest rates stood at 16%. So maybe people are saying, well, I'm not going to take on as much credit card debt because rates are now 22%. I don't think that's the case, though, because, I mean, if you're looking at a 16% hurdle rate, to me, the APR on credit cards never matters. Like, people are like, oh, I'm going to go with that credit card because it's 20% instead of 25%. That is just stupid in my mind because you shouldn't even be taking on debt at 20%. No. It's not a factor when I look at my credit cards. And I was blown away by this. I thought more people were on top of paying their credit cards. But this article I was reading was talking about how people are doing a better job, as just over half of cardholders, or 54%, typically pay in full. That means the other 46% are accruing interest. It's no wonder that banks are able to make so much money on these credit cards because a lot of people are accruing interest at a high degree.
I thought the number was more than that. I thought it was like 10 to 15% of borrowers pay all the interest for credit cards. But, you know, if 54% are paying in full, good for them. But like you said, I don't care what the interest rate is. You shouldn't ever carry debt if you can avoid it on a credit card. It could be 100%, you know. To me, it doesn't matter. If I get a credit card, it's based on the rewards and, you know, what I can use it for. I will never carry a balance on it.
Yeah, I mean, there's good debt, bad debt. I mean, I always look at good debt. It's going to be your mortgages, auto loans. Sometimes you can get good rates on auto loans. But, I mean, a lot of that's kind of dissipated even somewhat. I mean, there's really... The good debt as interest rates go up is harder and harder to find. And I think that's one thing that kind of fueled the economy for years was such low interest rates. I mean, you could get great debt on student loans, great debt on autos, great debt on homes. I mean, you talk about mortgage under 3%. It just made it so easy to borrow, and I think people got hooked on it.
Yeah. And I mean, mortgages have always been the best. With car loans, you know, some people don't like car loans at all. Because cars are depreciating assets. So, you know, borrowing to buy a depreciating asset. I don't look at it that way. I think if you're going to buy a car, you want to buy it in the most least expensive way, which if you can
it depreciates regardless.
Yeah. You know, whether you buy with cash or not, you want to pay for it in the least expensive way, which if you have a low rate, that's going to be the way to do it.
Yeah. And I mean, I think it is just so important to make sure you have your financial situation under control because, again, paying credit card interest to me is just one of the worst things you can do from a financial perspective.
It's the worst thing you can do, but it's also then when you're trying to do the right thing, it's very easy to know what the right thing to do is. You know, we can talk about investing and do all of these different things. If you have a balance on a credit card, that's where your money should go.
Yeah, exactly.
So that makes it easy.
Well, you know, we had a lot of time on the first subject there, so we still got a real estate kind of segment, I'll call it, where we're going to talk about real estate investors maybe supporting the real estate market. We'll talk about mortgages. Got some good stories there. So we're going to take a quick break, but we'll be right back after that short break. Alrighty, welcome back to the second half of the Smart Investing Show. Let's just jump right into it because we still got a lot to cover in the second half here. So we're going to talk about real estate investors maybe supporting the real estate market. And I was kind of surprised by this, but so far in 2025, investors have accounted for roughly 30% of all sales of both the existing and newly built homes. That is the highest share on record. And we are looking at lower sales volumes, but you know, to kind of see investors, they're kind of holding up the weight of those sales, I would say.
The highest share on record since they started tracking 14 years ago. So It's not, you know,
forever. Yeah.
not a huge
since
time.
Since the 1800s.
But yeah, but still, you know, 30% of sales is pretty large. And what I thought was really interesting about that is most of those investors were small investors. So that means investors with fewer than 100 homes. 100 homes isn't, you know, might not think of that as small, but, you know, of investors who owned fewer than 100 homes, they accounted for 25% of all of those purchases. So 30% was investors, and then 25% of the whole was, you know, small investors. So only 5% of purchases of new and existing homes were large investors.
I know, because you always hear clickbait like, "Oh, BlackRock is buying up all the homes out there," and it's like, I mean, no, like, not really.
Apparently not.
Apparently not. I mean, here's the data for you. And this is something that I'm going to say kind of scares me a little bit. But within the small investor space, again, you said fewer than 100 homes. I'm like, I don't know if I'd qualify somebody that owns 99 homes a small real estate investor. Yeah. But people that have just 3 to 9 properties, they accounted for between 14 and 15% of all sales each month this year. that to me is a little bit concerning because do they have full access to good data? Are they really looking at buying real estate fundamentally? Are they like, oh, I have a friend that made money in real estate. I heard I should be in real estate. They're not looking at the dynamics of the property. And are they maybe over leveraging themselves to just buy property?
I think that's a lot of it. And 3 to 9 properties, I would define more as a small investor. And I mean, we have seen it. We have, 800, 1,000 clients, whatever it is. A lot of them own real estate. And we've seen people who, buy a property because it's real estate. Yep. And I mean, Chase and I, we both own homes, so we have real estate too, but we don't have investment real estate. But it's people just have this emotional connection to real estate where they just want to buy it. Whether or not, who cares what the numbers are, but I'm going to buy this. Okay, I'm going to get a loan. I'm going to pay that mortgage. I'm going to rent it out. And I mean, we've had people that, buy property, they make their down payment or whatever, and they're losing money every single month because the rent that they can get, and they go into this knowing that the rent is not going to be enough to cover the mortgage and the taxes and insurance, let alone any repairs or vacancies that come up, but they do it because, it's real estate.
Yeah, and I think kind of in relation to the big companies here, the big companies are looking at this as a business, which is why I'm kind of following them. And the big companies, including like Invitation Homes and Progress Residential, those are 2 big public REITs, I believe, or big public owners of real estate. They've actually become net sellers in the market and are selling more properties than they are buying, likely due to reduced rents from the high competition in the rental market and a softening of the overall real estate market in certain areas that has not provided, the key word here, the expected return that they wanted. For these big companies, they're looking at, this is what our expectation is for a return. This is what our expectation is to get rental income. This is what we need the rents to grow to justify this investment. It's all based off the numbers, where the small investor doesn't look at that. Mm-hmm. If you ask the average small investor, and there are plenty out there that are very good real estate investors, so I don't want to knock all the small real estate investors here, right, but there are many, unfortunately, that I think are like, oh, yeah, no, I own real estate. Well, how are your returns? Like, what is your percentage gain on it? What is the ratio that you're getting in rents versus all the expenses you're paying? The average person doesn't know.
I've never had anybody tell me what their return has been on real estate. Also, for a grain of salt, a lot of people don't know what their returns in the stock market has been either. But with real estate, the return is more difficult to calculate because you have the influence of leverage, you have rents, you have vacancies, you have varying expenses and maintenance that come in. So it is difficult to keep track of what those returns are, especially if you have multiple properties. But the big investors are becoming net sellers of this, and a large part of that has to do with interest rates. Yeah. When interest rates are low, it was very easy to buy a property and then get enough rent, because rents were still going up. You could get enough rent to pay your overhead, so your cost of leverage and everything else. As interest rates have gone up, that hurt cash flow, which is one component of it, but then B, because of the higher interest rates, that slowed down the appreciation of properties. And these large residential, home buyers were banking on real estate prices appreciating at a certain point. And since they haven't, then now they're looking at selling because they don't have the cash flow, but they also don't have the appreciation to make up for the reduction in cash flow.
Yeah, and my concern too with the small investors, I think they kind of lag generally. So the big investors are doing it now, and then all of a sudden, maybe 3, 4, 5 years down the road, the small investor would be like, oh, I haven't made any money. Or
I don't think they'll even know.
I don't think they'll know. But my bigger concern is if something bad were to happen in the economy, they would be the most likely to not have the means to continue holding on to those investment properties.
Or they would do so at their detriment. Like withdraw from their 401k, pay taxes and penalties to keep paying their mortgage, or to do things like that.
Yeah, I think that is just again something to kind of keep an eye on, I guess, with the real estate market. And we've been, I'm going to say, big believers that the real estate market, kind of like the stock market, is not going to appreciate the way it has over the last few years. I think the real estate market has seen great appreciation. It's done very well. But just kind of being more realistic with your expectations on returns are so important now if you are looking at buying a property. And if you are looking at buying a property, please break down the numbers. It's so important to understand what you're investing your money into and making sure you are getting positive ROI or positive return on investment.
Moving on here.
Let's move on to kind of similar topic here. We're going to talk about mortgages. This will just be kind of more of the financial planning segment. So Harrison, I know you've had some kind of interesting conversations with people as mortgage rates have been a little bit more dynamic lately.
Yeah. So, I mean, interest rates spiked, right? But now we're a couple years into that, and they kind of peaked out in 2023. So we're about 2 years into when that really happened, a little bit more than 2 years actually. And in that time, rates have steadily decreased. So it's becoming more common for people to consider refinancing because they had bought a house in that time span or whatever. So it's becoming more common. Still, if you have a 2% mortgage, keep it, obviously.
Not gonna refinance.
But if you have a rate that's in the 6s or the 7s, it's there might be chances where you can refinance. And so I had somebody this week who was approached by a broker. Maybe they reached out to a broker. I don't know which way it went, but they had an opportunity, and I kind of wanted to go through those numbers because just because it might be a good time to refinance doesn't mean the way that you're structuring that refinance is efficient. So here's an example. I have a homeowner, and their current mortgage balance is $580,000. The interest rate that they have on it right now is 6.875%, and their monthly payment, principal and interest, is $3,900 a month. And they have the opportunity, and this is what was presented to them, they had the opportunity to refinance down to 5.5%, dropping their payment from $3,900 down to $3,500. With no additional cash to close. Anytime you refinance it, you close that, and sometimes you have cash to close. So there was no cash to close, and by doing this, they would save about $80,000 in interest. So it doesn't cost anything cash to close, so no out-of-pocket money to do it. Drops the interest rate, drops a payment, and drops the lifetime interest. So is this a good thing to do? Looking at it from that perspective, yes, it looks like it would be a good thing. But what is not obvious here is the reason they were able to not have any cash to close in this is because all of the costs, so the point cost, discount points, closing costs, the prepaids, all of that was just rolled into the new loan balance, and so their $580,000 mortgage became or would have become $616,000. So it was an increase of like $36,000 that they added to the balance. And if that was the only loan they were ever going to have again for the rest of their life, meaning they would never refinance it again because they couldn't for whatever reason, then that would be better than what they currently have. But you do have the option to refinance again if rates come down. So looking at this, the much better thing to do is to look at the environment and say, well, right now the rate is 6.875. Probably at some point in the next 30 years, it's going to be lower than that, or especially, in the next 5 years, which look to be about the break even on this. There's going to be an opportunity to refinance at a lower rate. And you might be able to get to 5.5% without paying huge amounts of points and then rolling those point costs into the loan balance. So whenever you're looking at doing a refinance, just because the refinance itself makes sense doesn't mean that, the way that loan is structured is the right way to do it. And it also, make sure that you're talking to a mortgage broker or a lender who knows what the hell they're doing, because this was really bad.
Well, and I know you kind of challenged the client, and then we're like, I wouldn't do that. And the mortgage broker, well, unless they know something different, the break even's like 18 months. And you're like, I don't know where they came up with that number, but they need to know the real break even.
Yeah, that was extremely misleading for a bunch of other reasons that we don't need to get into. But that client that we're talking about, they went and then talked to a different mortgage broker who basically came up with a very similar scenario. And so a lot of mortgage brokers out there, I have many who are friends, so I'm not talking bad about mortgage brokers, but a lot of them want to compete on the rate, and they'll do whatever they can to illustrate a low rate. In this case, it was 5.5%. Keep in mind, though, you're paying for that through points and discount points. So does it make sense to pay $20,000, $30,000 up front to get that low interest rate? Probably not, especially if interest rates are going to come down, which they should, and then you can just refinance into that rate in the future and not have to pay for it.
Yeah, and I do believe the hard part here is interest rates. It's hard to make a bet again on which way they're going to go. But looking over the long-term horizon, a 30-year mortgage, I gotta believe this is not the peak of where we're going to be. I think there's going to be opportunities to refinance down the road. I even think, as you said, within the next 5 years is very likely. There's two kind of counteracting facts that you got to consider. Number one is the government spending a ton of money. Now, people need to buy that debt. There needs to be that demand for the debt to drive rates lower. That is a big question mark in my mind. But on the other opposite side of the spectrum, we know the Fed is likely going to be cutting interest rates. Now, generally, the short end of the curve is the short end of the curve is moved by the Fed, and it doesn't necessarily move the long end of the curve, I'm going to say immediately. Like last year when they cut rates, the long end actually went up.
Yeah.
So are we going to see maybe a widening of the yield curve where short rates come down, long-term rates stay stable? I think that's likely, but I also think what will happen is the short end will come down, and I think the long end would come down slightly.
I think so too. Yeah, and when you're looking at refinancing and things like that, generally what I've seen is the break even on like paying points versus not usually is a break even of like 4-ish years. So if you're going to be able to refinance within a time span of 4 years, it's better to not pay any points now and still refinance, just maybe take a higher rate now and then refinance again at some point in the future, because you should be able to do so within 4 years. But you're right. Right now, short and long-term rates are pretty close. So I think what's likely to happen is Fed starts to cut rates, and then that spread gets a little bit larger. So the short-term rates come down. That won't have an immediate impact on 30-year mortgage rates, but eventually they will likely fall. And it's not like, oh, well, when are they going to get back to 3%?
That's not happening.
Maybe never. Yeah. I mean, maybe they will if we go through something cataclysmic and then the Fed has to drop rates to stimulate the economy like they did in COVID. Maybe we would see something like that, but it's going to take something extreme to get them that low. But they're like in the 6s right now. We could get into the 5s eventually.
Yeah. Yeah, and I think that's what a lot of mortgage brokers are trying to buy down into is the 5s. And I think, as you said, I think we can get there because you have to think about it. If the Fed cuts rates, short-term rates come down. As I said, I don't think it impacts long-term rates right away, but all of a sudden you have people that are in the money market, they're in a 2-year bond, they're getting 4%. They're kind of like, wow, this is nice. All of a sudden that drops to 2%. Well, they might start to look to expand duration to get higher interest rates. That then creates the demand on the longer end. That's why I think longer term you have those long rates come back down.
Yep.
But I think that's more a 2026, 2027 type scenario.
Mm-hmm.
So we'll have to see. But, great topic as always, Harrison. I think it's so important for people to actually look at, understand the numbers. I know that's something you do a great job of when you're working with your clients.
Like, do you hate these people? Why would you try to do this?
Trying to make the sale.
Yeah.
Well, with that, let's jump into some different companies here. The first one we want to take a look at is Carrier Global. And this one kind of has a personal avenue for me because my air conditioning unit broke over this past week, and I was like, "Oh man, this sucks."
Good week to have it happen.
Nice
been
heat
cold
here
out
in
there.
San Diego. Nice 96-degree weather with my 2 daughters. It was just not the best time to happen. So I was like, "Oh, I saw Carrier," and the main reason was actually I picked it before the air conditioning went out. But they slid like 10% last week after reporting in-line second quarter results. Management, I guess, told analysts on a conference call that the U.S. residential and light commercial sales are projected to decline 10% in the second half due to lower volumes. I was kind of surprised by that. I don't know if we're having nationally a lower kind of heat wave than normal or what's going on. I don't know what would lead to that decline in AC units, essentially.
Seems like it hasn't been as warm lately, but, I mean, we live in San Diego. It's always great here all the time.
Yeah, and I mean, the other thing, too, with Carrier, and obviously we talked about it, they provide HVAC. That's what they do. They provide the units. And I've heard different stories about how they could be big winners in the data center world because they get so hot. Mm-hmm. And you need to cool those data centers. And Carrier supposedly was going to be kind of an indirect data center play. But to have management come out and say, well, actually, projected sales are going to decline 10%. Well, aren't we building out all these data centers? Wouldn't you have to install the AC units beforehand? I don't know, I guess, the relationship there. But if you held this company on that hope, that'd be a red flag to me.
Yeah. And I mean, I wonder how big the scale of or the influence of that is because, I mean, Carrier is large. They're in almost every country in the world. So, not every country in the world is going to have massive data centers. So it might be that they are going to be a play on that, but there's just not enough data centers to have, a massive increase in revenue for them or not enough to justify it.
Yeah, and I was looking at this company, especially I like to find companies that have that decline and hopes that maybe there's some good valuations, and I hadn't looked at it yet. So I was disappointed to see the price to earnings right now is like 38 times. The industry average is 28.6. Price to sales is 2.6 versus 2 for the industry. Price to cash flow, this is a strange number, 59.2 versus the industry average is 17.4. So I'm not liking what I'm seeing in terms of the valuations. You get a very small yield of about 1.4%. Balance sheet is pretty good. Current ratio is 1.2, and debt to equity is about 0.8 or 80% there. So, I mean, those numbers all look quite strong. You got a good profit margin here for Carrier, 17.8%. So, I mean, I think it's maybe a good business. It's just obviously going through a cyclical period, and then it's overvalued. And I mean, you look at the current price here, it's $66.04. 52-week high is $83.32, and the low $54.22. But you go out to December 2026, estimated earnings per share is $3.46. Gives you a target sell of $57.44, so below that current price, unfortunately, for Carrier.
Yeah, well, I guess, do you know if you happened to get a Carrier HVAC?
I don't know what it was, because I didn't have to replace the whole unit, thankfully. I hear they run about $10,000 now.
Yeah.
So it was just a component inside that ran like $150 to just repair that little component.
Oh, well, maybe they're making them too good. You didn't have to buy a $10,000 one. They're only $150.
Well,
Not enough
actually,
revenue for them.
It's always kind of funny when you're talking to this client about like old refrigerators, and I know you have one.
It's in my garage. I love it. It's the one that I grew up in. My parents gave it to me.
And it's lasted forever. And like the new refrigerators seem to break so much more frequently. And then like, you know, the AC unit I have, I guess, was made in 2006. I just found that out today. So they're like, it generally runs around 20 years. But I'm like, are new AC units like new fridges where they're going to break more frequently, even though you're paying more for them? I don't know. I'm not an HVAC expert here.
Maybe Carrier needs to make them not as well, and they can sell more of them.
Yeah, it gives them a little bit more of a easier replacement cycle to continue to generate that revenue. All right, well, let's look at the next company here. The next company is Polaris Inc. Their ticker symbol is PII, and this is an interesting company. I know, Harrison, you have some information on what they do, so I'll kind of let you provide the details.
Founded in 1954 by a couple guys. One of them's name is David Johnson.
No way.
That's my father's name. Wasn't him, though. This company was founded before my dad was born. So, but Polaris, named after the North Star. They do all kinds of things: snowmobiles, adventure vehicles, ATVs, Indian motorcycles, off-road stuff, snow, marine, all kinds of different, vehicles like that. And I don't know. I mean, they're the company that makes razors. I don't know if you've ever sat in one of those things.
No.
It's like sitting in a cockpit. The newer ones are very fast, and I mean, I don't have one. My brother-in-law has one, and they all go out to the desert and stuff. And they're pretty cool and kind of scary to be in.
I didn't know they had the Indian motorcycles.
I didn't know that either. No.
Huh. They must have acquired that somewhat recently, potentially, because obviously Harley Davidson and Indian, but we've talked about Harley Davidson having issues with the demographic change. I'd assume Indian's going through the same situation where people aren't buying into the same capacity. I got to say, overall, my concern with the Polaris is its recreational vehicles, right? Snowmobiles, the razors in particular. If the economy slows, that probably would have a huge weight on sales for a company like this.
Yeah. I mean, it's a very expensive toy. A razor costs $30,000-$40,000. It's unbelievable. It's like buying a car. And yeah, that's not something that you're gonna buy if things slow down.
Yeah, and looking at the numbers here, I mean, some things that kind of stand out. The stock is, I'm gonna say, pretty heavily shorted. A short percentage of float's about 22%. Kind of surprised by that. No price to earnings, no earnings for the company. Price to sales at 0.4 is lower than the industry average at 0.6. Price to cash flow, so no earnings, but good cash flow here. Price to cash flow is 4.6, below the industry at 6.5. Tells me there's likely some non-cash expenses that took place for the company. You do get a nice dividend yield here of about 5.2%, so I'd say that's a big positive. No payout ratio since no earnings, but free cash flow payout ratio is 36.4. I wouldn't be troubled by that, honestly. I'd have to understand a little bit more about the earnings, but very big positive there to see they have plenty of free cash flow to pay that out. Balance sheet, question marks here. Current ratio is 1. Debt to equity, though, is about 170%. Big question I have for this company: do they carry the financing, or do they use a third party to do the financing? If they carry the financing, that's going to elevate that debt to equity and could still maybe make this balance sheet, I'm going to say, okay. Looking at the current price for Polaris, it's $51.44. It has pulled back from the 52-week high of $87.83, and the low here is $30.92. See, year-to-date, the stock is down about 7.8%, and frankly, just not been a good long-term performer. 1 year down 31%, 3 year down 50%, 5 year down 42%, 10 year down 50%. Gosh, I guess people haven't been buying enough of the razors and the snowmobiles out there.
I know a lot of people buy used ones, so maybe that's part of it. You buy one, you have it for 2 years, and you sell it, so there's just this massive aftermarket for it, and I mean, maybe the new sales really isn't in there because they're so expensive. And that could also, I mean, as far as the stock goes, the decline that the stock prices had could be part of the reason why the dividend yield is higher. Didn't used to be that high, but as the stock price declined, that yield just kind of got higher and higher.
Yeah, no, that's a good point. Understanding the way dividends function. But I'm kind of surprised by this. I was hoping that maybe this could be something positive. Again, I love companies with good yields. Company has apparently good cash flow. Earnings have been a problem. Again, I'm assuming it's because of write-downs. But even going out to December 2026, I see estimated earnings per share just $1.06, gives us a target sale of about $17.60, so well below that current level. Appears there's potentially some issues going on with Polaris, and if the lack of earnings bleeds over into cash flow, that could cause a dividend cut, which would be very disappointing if you bought this company for the dividend.
Yeah. I mean, wow, I can't believe that their earnings are that low. Is it competition that they're dealing with, maybe? I mean, I know that there's, now they're competing with General Motors because things cost the same amount as buy a car.
Oh, $30,000. Wow, that's crazy. Well, let's move on to the last company here, and this one's Align Technology. Kind of easier. I think you have a little bit more information on what they do here, Harrison.
Let's see. They are an alternative for braces. I wish I would have known about these things when I had braces. I had braces twice.
I think it's the Invisalign is what they have,
yes,
right?
Invisalign,
I've seen the ads for it. I don't know anybody that's willingly told me they've used Invisalign. I don't think it's a question I've really asked, so I don't know how successful the product is. But I
think they're becoming more prevalent because I know whether it's Invisalign, I'm assuming it is not braces, but the clear retainer type deals that straighten your teeth, and you kind of get different ones as your teeth get more and more straight. So it's a less invasive thing than braces are. So I know a couple people that have used them, and I think it's cheaper than traditional braces because you're not as involved with an orthodontist.
Because they're kind of operate through the direct consumer model. I think where they send in a mold and then they
3D print them. So, and I think Align Technology has a special type of material that they use to it. And so I think it's an easier way, maybe a cheaper way. I don't know if it's quicker than like traditional braces are, but I know a lot of people don't like braces. I don't.
Yeah.
I was 22 when I had them. That was the worst. Chase and I going around in college, and senior year in college with braces. It was awesome.
It was cool guy to walk around with.
Made you look good.
Exactly. No, that's why we hung out so much. But looking at Invisalign or Align Technology, I guess you should say, the reason this one was interesting was the stock sank about 30% after the manufacturer missed on earnings and revenue, and then their guidance for revenue came in at $965 million to $985 million for the quarter. That was short of the analyst expectation of $1.04 billion, but I'm like, gosh, to fall 30%, I mean, that could present some opportunities. Looking on the trailing 12 months worth of earnings, though, that not quite. I mean, price to earnings still about 23.6. Looking at price to sales, 2.6 versus the industry average of 3.8. That's positive. Price to cash flow, not bad, 14.1. Also below the industry average of 22.9. You're getting decent growth here. Analysts are expecting this to grow about 13.9%. It looks like per year over the next 5 years. Produces a good PEG ratio of 0.9. No dividend, but the company has bought back a decent amount of stock with a buyback yield of about 4.7%. With the stock depressed like this, if they are able to continue buybacks, they could buy back even more of the shares outstanding, which would be a positive. Balance sheet's very good. Current ratio is 1.2. Debt to equity. No debt on the balance sheet. Love to see that. Current price for Align Technology, ticker symbol is ALGN. It is $139.88. 52-week highs $262.87, and the low $127.70. As I said, fell after the earnings, so year-to-date return is now down 32.9%, 3-year return down 52%, 5-year down 53%, 10-year up about 129%. But this is where it gets intriguing. Going forward out to December 2026, estimated earnings per share here, $10.90. I mean, we get a target sell price of $180.94. It trades at under 13 times those future earnings. So, I'm not going to come out and say, yeah, this is a great buy, but I mean, I'm going to say it's intriguing. I mean, if it falls further, this could be a great buy.
Yeah, I mean, that's interesting. It looks like it peaked out in 2021 at almost like 750, down 80% since then.
Yeah, I mean, maybe an opportunity. Want to understand more about the industry to see if there is potential continued growth there. But thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Chase Wilsey, or Brent Wilsey as well at 858-224-0004. Please visit our website at smartinvesting2000.com. That's smartinvesting2000.com. You can sign up for the newsletter and also listen to past podcasts there as well. Have a great day. We'll talk more next week.